Hey everybody, I got 3 stocks for you guys today. I've got 3 things that have excellent margins of safety. I own all 3 stocks, so just a quick disclaimer before we get into this. I own all 3. Take that and invest at your own risk, but I'm going to get into it right now. So first stock is NAII, Natural International Alternatives. It sells on the NASDAQ. And right now, if we take a look, NAII is selling for $39 million. And as you can see, in the last year to 2 years, NAII fell from approximately a $100 to a $130 million security all the way down to a $33 million security. And I actually made a YouTube video on this stock before I get into it, if you guys want to check it out. I made a full breakdown, NAII. I called it the capital opportunity of the year at $33 million. So take a look. It's on my main page on my channel. But on simple terms, I think NAII is worth double the current market cap and then a little bit more too. We've got $39 million as of close on Friday, yesterday, September 8th. And I've got this stock at a conservative fair value of $80 million. And the reason why, if we want to take a look at the 10Q, I like looking at the 10Qs, but NAII has $124 million in tangible assets minus the operating right of use assets. And they've got $37 million in liabilities, again, without the lease assets. That's an excellent ratio. They're really, really well capitalized. It's a very safe business. But just in the assets alone, I think we're looking at a business that owns $80 million worth of assets without taking into account liquidation value. But that gives us a wonderful margin of safety at $40 million. And NAII is actually a stock, if we want to flash back to the 2018 10Q, NAII is a stock that went from a very clean current asset capital position into investing into new properties and new equipment, especially recently. And so when we look at their current 2023 10Q, to flash back, we've got 66 in current assets. And if you just take the current assets and minus the total liabilities minus the 20 million, you've already got $30 million worth of value. And that's why I called this the capital opportunity of the year at $33 million. It's because at $33 million, we are so far below what the assets are worth, in my opinion, that I hadn't seen anything like that all year. And then on top of that, we've got $54 million in property and equipment. And that might sound a little alarming at first, but those are recent investments. So if you look at the cash flow or net income history for NAII, you need to take into account that they've invested a lot recently into property and equipment for new ventures. And that has to do with the big problem at NAII, which was the stock price collapse of about 20 to 25% 2 weeks ago, which caused the capital opportunity of the year. But that collapse was caused by news that demand was softening so that their new facility had to close for a while, the one that manufactures for probably Juice Plus. It's one of the biggest customers. It's either Juice Plus or the other one. It doesn't really matter, though. But what we're looking at is a situation where NAII has softening demand. But just because you have softening demand does not justify the current price. All prices need to be justified. And I've got NAII right here at my number 1 capital idea, with the balance sheet alone as my thesis, at an $80 million conservative estimate. And to wrap off NAII, I'm just going to do a quick look at net income history, last 12 years. Let's go to macro trends. We've got increasing revenues. Revenues increased from 70 million or so at the start of the 2010s to 170, 180 million today. It's a growth company, a moderate growth company. But it's the net income that really makes me like NAII. And it's the consistency. I went through every single year of NAII's earning history. And it has almost never happened. It has never happened that NAII had a negative year in earnings outside of write-offs or a customer loss. And so I really like the consistency of how often NAII profits so long as a customer follows through with an approximate amount of orders compared to what they made last quarter. And that's what happened in the first quarter of 2023. NAII had a customer that went from their third biggest customer to almost nothing. And that is what caused the earnings deficit, the minus $2 million in the first quarter. But I expect that to turn around. NAII has a great history of at least making a net income in situations where they have an average quarter in terms of extraneous circumstances that can happen. And so with NAII, I'm really looking at a thing that I think is at like 4 or 5 times true earnings, like normalized average earnings, and it's at half actual asset value too. And that's why it's my number one capital idea. Next stock, guys, we've got JCTCF, Jewett Cameron, also sells on the NASDAQ, very cheap. If we take a look at the price of JCTCF, it's $16 million. Quick disclaimer, I own 0.5% of this business. I bought 0.5% of this business last month, and I've been waiting for this stock to drop again. It has not. And so I'm kind of sitting here hoping that this stock will fall a little bit more so that I can buy more. But I bought 0.5% of JCTCF right below a $15 million market cap. And so if we take a look, we'll notice it's another cigar butt. I like recommending cigar butts. But JCTCF has a long history of being publicly listed. And we've also got a long history of very solid earnings reports. And another thing very quickly that we need to be screening for when we look at stocks like JCTCF is if their return on assets over a very long period of time is acceptable. Forgot to mention with NAII, but NAII has a very long history of about a 6 or 7% return on assets, which is subpar, but in very low pricing circumstances where you can buy back shares, you can actually inflate that by a bit. But with a cigar butt like JCTCF, I actually give JCTCF a bit of credit in terms of its history because it has a 9 to 10% return on actual assets, tangible assets over long periods of time. And so it's a very solid business. That's the first thing that stands out when I look at it. But at $16 million, if we want to go over to the 10Q, JCTCF, the latest 10Q was on May 30, showed us assets as of May 31st, 2023. We've got 37 actually million in tangible assets. And we have only 13 in total liabilities. So first of all, at 16 million market cap, that's got to be sticking out to you as something that could be inefficient, something that you have to look into. So that's what I saw right away when I looked into JCTCF before making a position. But it's the cleanliness of this balance sheet that I love the most. JCTCF, let's go through the balance sheet. Cash and cash equivalents, accounts receivable, inventory, and then right there, you already passed $31 million. So you've got $31 million in on just those items alone, on 13 in total liabilities. Interesting. That's already $2 million over the current $16 million market cap. And then on top of that, you get $4.7 million of property, plant, and equipment at buy cost, which is mostly property. And you've only got $100,000 of intangible assets worth nothing, obviously. Then you've got $400,000 in deferred tax assets. That is one of the cleanest, easiest to value balance sheets I've ever seen in my life. That's what I like about JCTCF, is I feel like as I value JCTCF, my valuation comes not just from the assets, but from the earning history and how consistent it's been. Let's take a look at JCTCF's earning history. If we look at revenues, JCTCF is a moderate growth company that has a good to average return on assets. But as you can see, revenues, I don't need revenues to be increasing, but they are slightly. And then net incomes, they have a very, very consistent history of generating between $2 and $3 million worth of net income. And nothing has materially changed at JCTCF that caused the price drop. It was just a slight margin compression during a tough era for margins, for products, for materials, I mean. But my estimate as I look at JCTCF is that I'm buying into something, I bought at $15 million. I bought into something at 15 that holds a very true value of 24 million in intangible asset value. And it has an earning power of 3 million. That was my thought. And so at $15 million, I felt like I was buying into something that was at 5 times true earnings and was also at about 0.6 tangible book value. And that calculated with the return on assets that I've seen over time, plus a relative analysis of how good the business is from a product standpoint. It doesn't have to be great, but it just has to be something. That gave me the belief that JCTCF is worth 27 to 30 million in a very assured way. And that's why I bought 0.5% of the business at just below $15 million. But if we go back to the balance sheet, it's just so clean, guys. And this is what you look for. Total tangible stockholder equity of $23.7 million. And the current market cap is 16. I don't love I do like JCTCF at $16 million. I'm just waiting with my money for it to get a little bit cheaper. But at 16, it's still here as one of my best stock ideas. And if I didn't own it today and looked at today's price, I would probably definitely buy it at 16 million. Again, do your own due diligence. That's my second best stock idea. JCTCF, I think it's worth 27 to 30 million dollars, not 16 like the current market cap. Okay, so guys, stock number 3. We're going to be hitting into Jerash Holdings, Jerash, JRSH. And so let's take a look at the 10Q for Jerash Holdings as of June 2023. We've got in a very safe business. I'm finding you guys 3 stocks today that have an excellent margin of safety. Jerash Holdings has $18 million in cash, 6 in accounts receivable, 24 in inventories, and you've got a total current asset value of 55 million. Now let's stop right there. And if you look at total liabilities, we've got 14 in total liabilities. So that right there is $40 million worth of net current asset value. And the market cap for Jerash Holdings, if we want to look at the price at the moment, is $40.5 million, closing as of Friday, September 8th, yesterday. So Jerash Holdings became interesting to me right here when it dropped below 40 million. And I like it right here because of how sure I am of the asset value on their balance sheet relative to what it's selling for. It gives me a great margin of safety. That's exactly what you're supposed to think like in terms of a margin of safety. So total current assets, 55 million, total liabilities, 14, that's $41 million. And then you get 23 million in property, plant, and equipment for free beyond the price, along with, a good 2-3 million in other assets, giving us a total asset value of 82.4 million. And with total liabilities of 14, we have a total equity of 68 million. And one thing to note about Jerash is that even though they've issued shares over the last 10 years, while they've grown their business, this is a rapid growth business, guys. They actually bought back 2% of shares last quarter, which shows me that they have an initiation to buy back shares only at prices that are well below the value of the business, which is really good to see. So Jerash Holdings, it's got 68 in total equity, it's tangible equity as well. Their return on assets is not just good, but great. If I look back at their business's history, they are a rapid growth business, unlike the previous two, JCTCF and NAII. But Jerash has grown very fast from a very small business just in the last 15 years. And their total return on assets is actually north of 10% over that time. And they've only been publicly listed for 6 years, so I can only give you some data in the last 6. You're going to have to trust me for the rest. But if we look at their revenues, they've doubled revenues in the last 5 years. And they've also generated or shown that they can generate 9 to 10 million at best in net income trailing for 4 months or 4 quarters. So when I look at Jerash, it's just like the other two businesses where I feel like I'm buying into something that's at well below current asset value. And it's also at a very, very low multiple to what I think relative earnings should be for the business. And so with Jerash, it's another one where I think that my normalized earnings are going to be about it's going to be 5x earnings. And then I'm going to be looking at about 0.6 tangible book value at current levels. I think Jerash is worth much more, like $80 million, so double the current market cap, and that's still a conservative value considering how fast they've grown since it became a business in about 2002. And so to make a note on Jerash and all the other businesses I've recommended, they're cigar butts. They're things that got too cheap. And so you're going to have factors that have made the stock cheap. But in these situations, you're going to be having to decide whether or not the price is justified. And so guys, take a look at all 3 of these stocks. Do your own due diligence, but I recommend all 3 things for my own portfolio. These are all 3 things that I've bought in. Right here, very close to all of the current prices for all 3 of these stocks. And I'm one of the only YouTubers that's going to give you a stock with an actual margin of safety. I don't give you guys stuff that I'm guessing on or that I am not buying myself. I'm going to be putting my money where my mouth is and also giving you things that actually have logic behind them in terms of why I think there's a mispricing beyond my expectation of future earnings, which is me giving you something with a margin of safety. Almost nobody gives you something with a margin of safety anymore. So guys, 3 stocks, JCTCF, NAII, JRSH. I've got all 3. I'm looking at them. I all think they're worth about double the current market cap. Take a look. Have fun.